Hello and welcome to Swing Trading Bootcamp. In this first video, we'll talk about the most basic of technical analysis, support and resistance levels, and how to use them. A support level is simply an area where price is supported in the market. So in other words, it means the price can't break down below it. There are buyers underneath looking to push the price of the stock higher. Resistance is the exact opposite. It's an area where a price just doesn't seem to be able to break above, and the sellers come in and overwhelm. What's interesting about support and resistance is there is something called market memory. So you'll have levels throughout the chart where support and resistance occurs time and time again. And what you'll have is very much like a high rise. Say you have 3 levels on a building. What is the ceiling here on level 1, if you go upstairs to level 2, becomes the floor. In other words, what was resistance becomes support. Just as if you break back down, what was support becomes resistance. There are a lot of reasons for this, but the most basic of reasons is simply that if you are, for example, if you are short of the market, at this price here, which is $82. Let's just say you've done okay. This area is held, but eventually it breaks. So at this point in time, you're losing money. You are starting to lose money in your position. And that, of course, is something that makes people very nervous. If we pull back, most losing traders are going to be willing to take a small loss or get out of the position to break even if they get really lucky. So they are encouraged by the price action to buy the position back, closing it out as close to break even as possible. There are another group of traders who have missed the move and are waiting for this opportunity to go long. So you have 2 sets of traders that are willing to buy in this area. One because they have to get out alive, basically, and the other group because they want to participate. And of course, it works in both ways. So if you have support that finally was broken through, we may bounce back here. People who had been long are willing to close out the position here. Those who have been looking to short and saw this move but saw it too late are looking to get involved. It's called market memory. The phrase you hear quite often is what was once the ceiling becomes the floor and vice versa. Another thing that's interesting about support and resistance is that it tends to happen at round numbers. It tends to happen over time at the same area. So here on the weekly chart, and I would also point out that when you go marking up support and resistance on the chart, you do it from a higher time frame initially. Something that you'll find interesting is quite often if you simply put these numbers in at round numbers. So for example, at every 10 or maybe every $5, and there will be the occasional exception here, like at 78, where you can clearly see the market had struggled. Look how many times we hit there before we finally broke out. Then we found a little bit of support. We tried to come back and we struggled there as well. But what you'll find is a lot of times if you put numbers that are round up on a chart, you will find a bit of a pattern. So in this case, I'm going to go ahead and put, let's just say every $5 for now, and see what that gets us. And again, remember, I'm on the weekly chart, so what I'll do is then I will drill down to the daily chart. And now you can see how the market doesn't look so random after all. You can see that down here at 55, you can make an argument for that as well, but you can see every $5 there does seem to be a reaction. Now, here's the thing. Does it mean that you should short as soon as it gets to 75 if we're rising? Well, no, because you could have said the same thing about 65 and you would have been wrong for quite some time. But what it does tell you is this is where you look for price action to confirm a trade because you know there's interest in this market at these levels. Your first assignment as a technical analyst, because all traders who use technical analysis are technical analysts, is to open up as many charts as you can and just pound it in your head so that you can just look at major areas and see them immediately when you open up. Start out on the weekly, go down to the daily. You can go down further, but the problem is once you start going down further than that, you really start to clutter up the chart and you start to talk about minor levels. At that point, you're talking more like day trading and scalping. Swing trading, you're looking at daily and weekly because you want to catch the bigger moves. You want the higher probability trades. So when we get these areas, you then look for signals based upon price patterns or candlesticks to place a trade in the appropriate direction with, for example, if you shorted here, with an eye on 65 as a target. Or if you bought here, there's a signal there in the form of a candlestick called a hammer. We'll talk about that later. $65 makes a lot of sense for a target, and that's exactly where you went. So get as many charts in front of you as you can. Start looking at the big numbers, but do recognize there are going to be times where it's obvious that it's a different level. It's not just, every $10 or $5. But you'll be surprised at how symmetric a lot of the support resistance is because most of what markets are doing, they're just going from point A to point B to point C to point B to point A, back to point C. They're just ping-ponging between various levels. It's an auction. So by all means, experiment with this as much as possible. But keep in mind, these aren't hard levels. In other words, it's not like you can say that 82 is resistance, and therefore, if we get to 82.02, resistance is broken. No, you're looking for price action in that little area. It's a little bit of a zone. So keep that in mind as well.